Welcome everyone, and good morning to you all, and thanks for joining us for our Sunsuper webcast. Let me introduce myself. My name's Mark Stubbings. I've got the pleasure of being your host this morning, and this first webcast we're actually going to look at a particular asset class, but it's part of a much broader series where we actually deep dive down into our asset classes. This webcast is designed for financial advisors, dealer groups and industry participants, and is obviously tailored accordingly. What are we trying to achieve? We're trying to achieve with this webcast series an insight and an update into the various asset classes we have. We're looking to talk about the objectives, the constructions, the holdings in those various asset classes, and obviously the performance. We are also trying to be very open and transparent in these very, very difficult times. Obviously, we are in unique times, so to play things with a straight bat is very important for advisors and also for their clients. We're actually going to look across a number of asset classes over the intervening weeks. We'll look at infrastructure, private capital, alternative strategies, but we'll also look at our equity holdings, which obviously include our index options. Today, however, we're focusing on our property asset class. Let me give you a little bit of an idea of the agenda. We're going to welcome very shortly Head of Private Markets, Michael Weaver, who will actually talk to us today. And first up, he's going to give a short presentation on the property asset class. We've designed this so that although he frames up the conversation, the desire is to answer your questions, the audience's questions. We've received a number up to this webcast, and we're actually going to answer those, but we will be taking live questions during the broadcast, and we really hope that you participate and join in. Just a bit of housekeeping to help you with that. To submit questions, you click on the speech bubble, bottom right of your screen. I've got the pleasure to be with Will Burke today, and Will's sitting to my right, and he's going to curate the questions. Just be aware there is a few second time delay between submitting and receiving. We'll try our best to answer as many as possible. If we can't answer them, we'd encourage you to touch base with the business development team, and we'll endeavour to do that. We've got a legal disclaimer that I need to read through now. Obviously, the information presented today is general and doesn't take into account a person's personal financial situation and goals. Let me now introduce our speaker today, Michael Weaver. Michael is Head of Private Markets. He leads a team managing property, infrastructure and private capital. He's concerned with portfolio construction, investment research selection, ongoing reviews and reporting. The property portfolio, which is obviously part of his brief, has $6 billion worth of investment in funds and direct assets in Australia and offshore. A little bit of Michael's pedigree. He's had 14 years at Sunsuper, 9 years prior to that with Mercer, dealing with large corporate clients. He's got a Bachelor of Business, a graduate certificate in management, and also a Masters of Applied Finance and Investment. So now I'll pass over to Michael Weaver. Michael.
Thank you, Mark. So on slide 5 here, we have the asset class, a little bit about the portfolio. So as I mentioned, or as Mark mentioned, just over $6 billion is invested in the property asset class. And that makes up around 8.5 to 10.5% of the different diversified options that most of our members are invested in. We also have a property option, which makes up a big portion of as well. What are we after with the unlisted property that we invest in? We're really after sort of pure play property. And what do I mean by that? I mean, we're after tangible assets, real buildings, so shopping centres, office, towers, industrial and logistics sheds, other investments we have such as self-storage, residential for rent, even holiday parks and data centres. So a wide variety of assets, but we're after real income that they generate. So we don't do a lot of development, for example. We're not really that focused on the capital gain. We expect capital gain over time. There is some growth from these this portfolio, but it's more around how much income can we have, the stability of those leases. Moving on to the next slide, how do we go and invest in this asset class? We invest by partnering with great managers, and that's both here and offshore. It is a diversified portfolio. I've got some numbers on that in a minute. But really, we look to partner with the best operators. We don't try and do everything ourselves. We're selecting what sort of assets that we want. Managers are best placed to look after those assets. And we invest in both equity and into debt investments. So debt investments make up about 15% of the portfolio. And we think there's an attractive risk return basis in some certain debt investments that we make. Equity is around 85% of the portfolio, but we have relatively low gearing, or compared to some people who invest in large commercial property. It ends up being around 20% on average across that portfolio. So that's a prudent level of gearing, despite how attractive low rates are in today's market. So what are we trying to achieve? We're trying to achieve long-term outperformance of a mix of equities and bonds. That's where we take the money from. So we're after diversification away from equities and bonds. So you have some growth, you have some income coming through, generally a lot higher than what bonds or cash will offer you today. But we expect that premium over time, generally called an illiquidity premium. We take money out of more listed liquid markets, invested in unlisted, and expect a premium. And then we also compare ourselves, if you look at the bottom right of that slide 6, the target outperformance against some unlisted peers. So different asset classes in both here, US and Europe have different benchmarks that we can compare ourselves to make sure that we're getting great returns for our members. On to the next slide, the graph shows, or the chart shows a nice mix of the portfolio. So retail is around, it says 22% of the portfolio. We have a large amount in office, but also for rent residential. So that's multifamily, some aged care assets, particularly in the US, quite a lot of multifamily over there, which is, think of it like a big Meriton apartment, but it's only run by the one operator and it's only for rent. They don't sell off any of those underlying units. So yeah, it's quite a big asset class in the US. We've tried, or different people have tried to make it start here in Australia, and I think that'll occur over time, but it's still in a pretty early stage compared to the US, where it's been an established asset class for over 30 years. Industrial logistics assets, some self-storage, and in other, we have our holiday parks and data centres, as well as some other assets such as medical office. The next slide shows where we invest. So very large portion in Australia, but about 10 years ago we diversified offshore, not necessarily to get higher returns. Some people invest offshore for higher returns. We looked at it as a way of reducing risk. We're a global investor. We have lots of assets offshore in both our equities portfolio, our bond portfolio. Australia is a narrower market for, so you wouldn't be able to access things like the multifamily residential here, and some of the other asset classes in Australia or sectors aren't as broad. So we think going offshore so actually has been accretive to returns, but that's not the primary reason why we invested offshore. Just under 10% in Europe, and then Asia, while we've done a lot of research there, it's really just an early stage, only 1%. We expect that to increase over time, but Asia is generally a more volatile market, shorter term leases, doesn't give us the stability of income. So what we have there is industrial and logistics assets, and we expect those to increase in over time. On to the next slide. One of the questions we get asked a lot is, why do you invest in unlisted property as opposed to listed property? And how does unlisted generally perform compared to listed property? And it's an ongoing discussion that we have with a lot of people. And really, it's basically that first reason why we invest in property, to give that diversification away from equities and to get that pure play property. It's a lot harder in the listed market. So there's some great listed companies, great management teams, great assets underneath, but sometimes it's really hard to get to know exactly what you're going to own over time. because they might have large development pipelines. They might make some capital transactions such as buying a competitor or using gearing to invest offshore. You're just not exactly sure what you're necessarily going to get. Some of them have large funds management businesses. They could be good businesses, but when there's a downturn, they get impacted more than if it was just pure property. And so that's one main reason. The other reason is really demonstrated on this chart that the listed market will value some of these companies at more or less than what the underlying asset value actually is because of the market sentiment and how equity markets are tracking in general. So you can see on the chart, it can be up to 30% above, 30% below what the underlying values actually are. Now, the underlying values of most of those businesses are tracked exactly the same way as what we have in the unlisted market. So external valuation firms, independently done on a regular basis. But the market sentiment can drive it above or beyond. So it's really those two main factors that have made it hard for us to allocate to the listed market. I might pause there, Mark, and if there's questions, we can start those now.
Thanks, Michael, and that was a good presentation, very good grounding. Maybe I can start off with some questions that we've received up to now, so we've obviously had a bit of a chance to prepare some answers for, and then we'll dip into some of the live questions. So first up, COVID-19, the whole situation, just in the context of that, what has been the impact on unlisted property earnings and also valuations, Michael?
Yeah, thanks, Mark. And as you said, it's obviously a very hot topic right now, and there's been a lot of press around what's going to be the impact on shopping centres, office buildings, and things like that. So, we've spent a lot of the last few months really digging deep into what those impacts are likely to be. It is quite sector specific. So, starting with retail property, that's the obvious one that when a lot of the retail shops decided to close because not many or barely anyone was coming to visit, that has a big impact on earnings. The government has come out with a tenancy code of conduct, so most of the businesses, both landlords and tenants, are working through that to determine what's a fair sort of balance of the impact of COVID. But there's no doubt that that's a short-term impact to earnings and could have implications over the medium to longer term as well, depending on how Australia and other countries that we invest in react and rebound from the impacts of COVID. Office buildings are a little different. It's very asset specific and tenant specific, similar to industrial and logistics parks. Reason for that is you can have some long-term tenants, stable businesses. That's going to be very different to if you were having a development on spec and trying to rent that out, or if you've just got an upcoming vacancy, you might have less certainty of being able to roll that over or get the value that you thought, the sort of income stream you thought you were going to get. And one of the next slide that we have is a building or a couple of buildings that we own a part of alongside Mirvac and AMP. It's called South Everleigh in Sydney, just the southern part of Sydney. That is two very large buildings and a small third building. CBA is the major tenant there. It's a long-term lease. Something like that we fully expect to be less impacted on a valuation basis than something that is a retail shopping centre or if you're building something on spec. So that's an interesting example. In terms of the actual impact, it is to valuations. Across the portfolio, the average write-down was about 7%. So we undertook a deep dive into each asset and sector across the portfolio during March, once COVID was obvious as to that there would be impacts. And we think that across the portfolio, the numbers are around 7% down. Shopping centres were 12.5% on average, and some office and industrial and other assets were less impacted. So things like multifamily, a small impact. We do expect to have some, or so far there has been some downturn in earnings in the short term, but you expect that to be bouncing back as COVID is recovered, or the rebound from COVID occurs over the next sort of 6 or 12 months in most areas. Another investment we have, I've got on the next slide, is called Discovery Parks. They own over 60 parks around the country, and also have marketing arrangement for another 200 parks, so a full network. This one's out at Rottnest Island in Western Australia. Beautiful park that I encourage you to go and visit sometime if you're ever out in WA. They had to shut a lot of their parks because of state government legislation. Made sense to close those. That had to be done, except for some essential workers, etc. But then they also had, that's in the holiday park area, but then they also had mining parks and workforce stay where they weren't needing to close those. They were able to keep going. So definitely a short-term impact on earnings, but then over the medium and longer term, we believe that there'll be a slower rebound in international travel, which should encourage more people to have a holiday at home. So, jumping in the car and going for a holiday is more likely to occur probably over the next 6 or 12 months than it might have been prior. So, already seeing bookings occur. I know that we're keen to, it's been fine being at home for a couple of months, but yeah, the family's keen to go and have a holiday. So yeah, we're booking one in for October. So yeah, hopefully a lot of you out there will also be able to find a nice park to go and have a nice family holiday in. Maybe I'll pause there. I can cover it in more detail if you like, Mark, but I think that's...
Thanks, Michael. And I've got to say that picture of Rottnest Island looks particularly attractive, mate. I might be second booking after you, my friend. Another question. Sunsuper classifies unlisted property as 50% growth, 50% defensive. Does this still hold true as a rule, given the impact to earnings that you've touched on?
Yeah, look, simple answer is we think it does. Look, that's a long-term expectation. Over the medium to long term, you expect to have 50% growth, 50% defensive characteristics from the asset class. And that's one of the reasons why we're funding it from equities and from bonds. And look, there's definitely a hit to earnings right now, but you do expect when there's a downturn in equities, you do expect some impact on the property asset class. To be immune doesn't really make sense when you're looking for long-term assets. So, but that short-term impact on earnings will be, as I mentioned, quite sector specific as to how long that will occur for. And when we look through the cycle, we say, well, do we think that still holds true? This is a different cycle. Every cycle's different. People wouldn't have expected, and when they expect in a downturn that you have a hit to earnings, they don't really expect that half your retail shopping centre is going to be closed. So as they open up and retailers work through how that all impacts, you will have more impact there. But then some of the other assets across the portfolio that aren't going to be impacted anywhere near as much. And that's why you have a diversified portfolio, so that you don't have all your eggs in one basket. No one can predict the future. We just have good estimates of what's occurring. And some of the assets have got good demographic trends behind them. So the multifamily in the US is still expanding in people. Some of the aged care assets that we have investments in, holiday parks, even good tourism over time. So yeah, we think those demographic trends will be helpful.
Excellent. Thank you, Michael. And Michael, we've talked about some, say, the adverse impacts of what's happening, but what are the opportunities in the market? Double barrel question. Are transactions occurring?
Yeah. Well, look, realistically, most of the market is still dealing with the fallout. So it's been a huge shock. If you compare it back to the global financial crisis, there was a lot more leading up to that crisis where people were thinking, could something, how bad is this going to be? Whereas this was a far quicker and earlier shock. So, and people are dealing with their own businesses, their own households, families, and then they're worrying about how they can work out the different, tenancy arrangements and issues like that. So there hasn't been a lot of transactions. A couple have paused, a couple have kept going. So some industrial and logistics processes we'd had a look at, thought the pricing was pretty pretty high. The whole market has been very high for those over the last couple of years. E-commerce has been very helpful. That's going to continue with retail being affected, actually helpful for industrial and logistics assets. And so some of those assets are going at similar, if not better prices than what was happening prior to the crisis. So there hasn't been enough time so far for sort of any real distress to come through the market. We think that might occur over the next 6 or 12 months, but it'll be dependent on how quickly markets rebound and economies and health systems in general rebound. So it will be quite country specific, we expect. And thankfully, Australia's so far done very well at coping with the crisis.
Awesome. Thank you, Michael. And what do you think, another double-barreled question, so I'll hit you with both at once. What is the outlook for unlisted property? Has the future fundamentally changed?
Yeah, look, I think, so starting with the first part, look, the outlook, as professional investors, we compare unlisted property to every other asset class that we invest in. So we're taking money out of equities and bonds, but we don't. That's one decision, but then we can invest in infrastructure assets or private equity or private debt. There's a lot of different opportunities out there. So we look at unlisted property compared to those. We believe that unlisted property will still remain attractive. Reasons are long-term demographic trends are helpful for property. When you've got high quality assets in good locations, they will continue to be attractive for investors long-term and be able to generate income streams. But it's also the relative attractiveness of equities and bonds. The bond rate, the 10-year bond rate in Australia is still under 1%. Equities have rebounded from their lows, but there's still a bit of uncertainty around underlying earnings. So people are looking at those and saying, well, property still gives me good stability of income, much higher income than what I'd get from bonds or cash, and good opportunity for growth. Maybe not huge growth, but at least good, attractive growth. So I think that's the property market in general. Once you get into different assets within the property asset class, I mentioned retail had been marked down more than the other asset classes, and it was already under pressure beforehand. It'll be interesting to see how that sort of online trend and how quickly people come back to shopping centres and looking to invest. I know that different views in the market on that as to what people are going to want to be doing. So yeah, I think that's quite interesting. Office, working from home, it's been a couple of months for us working from home. Most of the team is quite keen to come back to the office. Some are less so. I think there'll be more working from home and flexibility, but the death of the office has been talked about before, and I don't think this crisis will be that different. Obviously, the social distancing part of it, at least until there's a vaccine, will make it a little bit more difficult in offices. But the interconnectivity, humans are social beings, they like relationships. It is easier dealing with people in a meeting room, reading the room, than reading the Zoom. So you do find that most people you talk to, at least, are keen to come back to the office and have that interactivity. So I think that's good. And then there's other assets that are less impacted, or actually it's beneficial. So on the next slide, we have data centres, an investment in Switzerland, very long-term investment, very long-term tenant. The major tenant is Microsoft. There's a large amount of tenants, but Microsoft is the main one under a long-term contract. And they're seeing increased demand for data. So, we invested in this over a year ago. Something like that has good income, but also growth opportunities as it looks to grow.
Thank you, Michael. So what I might do now, Michael, is pass over to Will, who's sitting off camera, and let's do some live questions from our audience today. So Will, do you want to hit us with some of those, please?
Yeah, thanks, Mark. And there's a number of questions coming through, so please do keep them coming. The first question for you, Michael, from Russell Wadey, is how are your property investments held? Are they single property direct ownership or multiple direct properties housed in an external trust or similar? And are they geared?
Yeah, good question, Russell. And it was actually in my notes that I should have mentioned that earlier. One of the problems with live TV is, you get a phone call as as this occurs. So sorry about that. That wasn't me having a friend phone in for an answer. Look, the answer to your question is we invest directly in equity, but then also in debt. But directly into assets, but then also directly into property funds that have fund investments and lots of different underlying properties as well. So we're agnostic about which the best path is. It'll be very asset and opportunity specific. The second part of your question around gearing, across the equity part of the portfolio, we have gearing at around 20%. So rates are very attractive. We can get a lot more debt than that across the portfolio if we wished, but we think that's a prudent level of gearing for the sorts of opportunities that we're after.
Thanks, Michael. And a question from Steve. You mentioned you do valuations often. How often specifically? Is it monthly, yearly, etc.?
Yeah, so on a normal basis, again, it's asset specific. All the large assets are generally done on a quarterly basis, and we can do monthly updates, so monthly updates for income, etc. We valued everything in the portfolio during March, and then for any sizable asset and all the large funds that we invest in, they're all getting valued on a monthly basis as the COVID crisis continues on, and more information is known, whether for positive or negative. All of those come through and are considered into the valuations.
Thank you, Michael. And a question here from Steve Greatrex. It's a two-part question. The first part is it possible to get returns updated daily? And if you like, we can take that one offline. But the second part is, right now, the end of April figures look dire, but I suspect an updated report would look quite different. So perhaps if you can comment on the performance side of things in terms of to the end of April and how things are since then.
Yeah, so I'm not exactly sure what specifically you're referring to, Steve, but I think to the end of April, if you're looking at the property option that we have on the, so we have two different options on the platform. One is the property option, which has around 75% of what I've been talking about today of the unlisted assets and 25% of global REITs there for liquidity. And then we also have an A-REIT option, which is Australian REITs only, and an index option there that's 100% Australian REITs. Look, both options are being negatively impacted by markets, A-REITs more so. And then there was a rebound through April as markets recovered from their March lows. We don't, look, it's still relatively early to tell where markets go from here. The listed market, as I showed on one of the slides, quite volatile. It's really market sentiment that it will be driving those values right now, because people are basically trying to predict where they think values will be in future. Our external valuation process, we think, so what we did in March and when we took those valuations down, most of those when the formal valuations, external valuations have been updated for the end of April, they've all come in there or thereabouts where we took those marks in March. So we think that there's a stabilisation there. But if Australia continues to open up schools, work, restaurants, etc., then you would expect that there'd be more of that recovery back to where we were. But there's still a huge amount of people on JobKeeper. The economic uncertainty is real at this point. So I think that's still a good couple of months away until we see how Australia recovers from the downturn and JobKeeper, etc.
Thanks, Michael. And we are running pretty short on time, so perhaps if we got just a quick answer here. Another question from Russell Wadey. If you revalue an asset at, say, negative 10%, does the gearing at, say, 20% mean the overall downward impact is negative 12%?
I would have to double check that. Essentially, yes. So, yeah, if you're marking an asset down by 10%, yeah, the gearing will mean that it ends up being worse. I think the math would be a little bit different, but yes, essentially it's a larger impact the more gearing you have, which is when I mentioned that prudent level of gearing at 20%. Gearing helps you a lot when markets are good, and it hurts you when markets are poor. So.
Thank you, Michael. And look, very conscious of time. Appreciate all the questions coming in, and as I mentioned before, we're happy to take those offline and actually deal with the questioners direct. So please, with those questions or any others, the BDM team is most happy to help. Reach out to us. Let me take the opportunity to thank you, Michael, and obviously thank the listeners. As I say, we're very keen to be open and transparent in very, very difficult times to give you confidence and your clients confidence. There's material that I'll put up on the slide. It's a reference point on the Sunsuper website for you and your clients that you're most welcome to look at. Please don't miss the rest of the webcast series. We're looking to involve a number of other investment managers, and our investment managers will talk about, as we have done today, objectives, the constructions, the holdings and the performance of the various asset classes. Keep an eye out. An email will come out later, either today or tomorrow, of today's recording, and it will also have a registration link for the series. So I'd definitely invite you to join us for our other webcasts. So thank you, Michael. Thank you, listeners. Appreciate your time and trouble today. Thank you.